There is a strategy that allows institutions to earn a steady, double-digit annualized yield on Bitcoin without taking any bet on whether the price goes up or down. It is called the basis trade, or cash and carry arbitrage, and it is one of the most important and least understood engines of institutional yield in all of crypto. While retail investors focus on price direction, sophisticated funds have quietly been harvesting the gap between the spot price of Bitcoin and the price of Bitcoin futures. This gap is called the basis. When futures trade at a premium to spot, which they usually do in a healthy market, that premium can be captured as a nearly market-neutral return. Understanding how the basis trade works is essential, because it explains where a large share of institutional crypto yield genuinely comes from, why that yield rises and falls with a market cycle, and what risks are hiding inside a strategy that is often marketed as almost free money. The mechanics of the basis trade come down to 4 steps. First, the institution buys spot Bitcoin, or gains the same exposure through a spot Bitcoin exchange-traded fund. This is the long leg of the position. Second, at the same time, it sells a Bitcoin futures contract of equal size, usually on a regulated venue such as the Chicago Mercantile Exchange, at a price higher than spot. This short leg is where the premium is locked in. Third, the institution simply holds both legs. Because the long spot position and the short futures position are equal and opposite, any move in the price of Bitcoin cancels out. If Bitcoin rallies, the spot gains and the short future loses the same amount. If Bitcoin falls, the reverse happens. The position has almost no directional exposure. It is delta neutral. Fourth, and this is the key, as the futures contract approaches its expiry date, its price mechanically converges toward the spot price. The premium that the institution captured at the start is realized as pure profit. The result is a yield earned from the structure of the market itself, not from any correct prediction about the direction of Bitcoin. The critical thing to understand about the basis trade is that its yield is highly cyclical. It is not a fixed rate. It swings dramatically with market sentiment. At the peak of a bull market, when demand for leveraged long exposure is euphoric, the futures premium can explode. In the 2021 bull market, annualized basis yields briefly reached 30 to 40%, as speculators paid almost any price for leveraged upside. In periods of strong but healthier demand, such as the months following the launch of the spot Bitcoin exchange-traded funds in 2024, the basis has typically offered something in the range of 10 to 15% annualized. In normal, calm conditions, the market sits in what is called contango, with futures modestly above spot, delivering a more ordinary yield of perhaps 5 to 8%. When conviction is low and the market is flat, the premium compresses toward just a few percent. And crucially, in moments of genuine fear and heavy selling, the market can flip into backwardation, where futures trade below spot and the basis yield actually turns negative. The lesson for institutions is that basis yield is a barometer of leverage and sentiment. It is generous precisely when the market is most greedy, and it vanishes exactly when everyone wants it most. There are 2 main ways institutions actually execute the basis trade, and the choice between them defines the risk profile. The first is the classic cash and carry using regulated futures, most often on the Chicago Mercantile Exchange. Here the institution holds long spot Bitcoin, or a spot exchange-traded fund, and shorts a dated futures contract that expires on a fixed date. Because the CME is regulated and centrally cleared, counterparty risk is low, the return is locked to a known expiry, and the trade appeals to traditional institutions with strict compliance requirements. The yield is more modest, but the structure is clean and transparent. The second approach is perpetual funding capture. Instead of a dated future, the institution shorts a perpetual swap, a futures contract with no expiry, on an offshore crypto exchange, and collects the funding rate that leveraged longs must pay to shorts. This can generate significantly higher headline yields, often in the 10 to 30% range, because it harvests the constant demand for leverage in the crypto-native market. But it concentrates risk on largely unregulated venues, where the institution must trust the exchange with custody and settlement. The collapse of FTX was a brutal reminder that on these venues, the counterparty risk can be far larger than the yield. The same delta-neutral idea, executed through 2 very different instruments, produces 2 very different risk-return trade-offs. It is essential to understand that the basis trade is not free money, despite how it is often marketed. There are 4 specific risks institutions must underwrite. The first is margin and liquidation risk. The short futures leg must be collateralized with margin, and during a violent upward move in Bitcoin, that short leg can generate losses and margin calls faster than the institution can access the offsetting gains on its spot position. Poor collateral management can force a liquidation at exactly the wrong moment, turning a market-neutral trade into a real loss. The second is counterparty and custody risk. Especially on offshore exchanges, the institution's collateral is held by the venue itself. If that venue fails, halts withdrawals, or turns out to be fraudulent, the entire position can be lost, not merely the yield. This is precisely how many supposedly market-neutral strategies were destroyed in the collapse of exchanges like FTX. The third is basis and funding reversal. The premium the trade depends on can compress, disappear, or invert. Perpetual funding rates can turn negative and start costing the position money. The fourth is capital efficiency and rolling risk. Capital is locked across two legs, reducing flexibility, and dated positions must be rolled forward at each expiry, incurring transaction costs and repricing the basis at whatever the market offers at that moment. A strategy that looks almost riskless on paper carries very real tail risks in practice. The institutional verdict on the basis trade comes down to four conclusions for capital allocators. First, it is genuinely market-neutral yield, not a directional bet. The return is engineered from the structure of the futures curve rather than from any view on price, which makes it a financing and arbitrage strategy rather than a speculative one. Second, the yield itself is a powerful sentiment barometer. When the basis is rich, it is telling you that leverage is crowded and the market is greedy. When it compresses or turns negative, it is signaling fear and forced selling. Sophisticated desks read the basis as a signal, not just a source of return. Third, the execution venue defines the real risk. A regulated cash and carry on the CME is clean and transparent but lower yielding, while offshore perpetual funding capture pays substantially more but concentrates the kind of counterparty risk that has repeatedly proven fatal in crypto. Fourth, the basis trade must be underwritten as arbitrage, not treated as a savings account. Rigorous margin discipline, serious counterparty diligence, and realistic assumptions about basis compression are what separate a durable, professional strategy from a hidden blow-up waiting for the next violent move in the market. The basis trade is one of the most important and least understood dimensions of institutional crypto, the market-neutral engine behind much of the yield that sophisticated funds quietly earn. Understanding it clarifies where returns actually come from, why they rise and fall with the cycle, and what risks lie beneath the surface. For more institutional-grade analysis of the protocols, market structure, and strategies that shape digital assets, subscribe to Crypto Mechanics.